welcome to the latest training that we've got for you inside the Academy, which is for our newest strategy called the Gamma Overlay. I know a lot of you have been waiting for this, and today I'm going to be showing you the first part of how the strategy works, in particular focusing on the underlying concept that we use when looking to trade overlay strategies generally. Then delving into a bit more detail about the selection criteria and so on. But it's important that we start off with an understanding of why we use an overlay strategy in the first place, because it is not entirely intuitive to most traders. All right, so first of all, when you watch this inside of the Academy, more of the training will, of course, be completed. So it won't necessarily look exactly like this, but let's jump into the underlying conceptual basis for the strategy. It's really important that every single strategy that you trade has got some conceptual basis that underpins the purpose of the strategy. With the overlay, we are trading a strategy that is not principally designed to be profitable. Now, most people find that to be a very strange concept in trading. And certainly when it comes to talking to your average retail trader, all they're interested in is finding strategies that make them money. And of course, that's one of the reasons why 99 or so % of people who try trading will fail. Because it simply illustrates that they are only paying lip service to the principle of capital protection first. It means that they are, in fact, putting profitability first. And you, unfortunately, can't do that and hope to survive long term. So we all know that it is important to manage risk before anything else at an intellectual level, but very few people act out according to that principle. And as I often say to people, what you tell me is one thing, but I'll know a lot more about you by looking at what you do. And certainly when it comes to this principle, that is very, very true. Now, why then would you trade a strategy that doesn't make money? Well, just because it doesn't make money doesn't mean it loses money either. Now, for every more advanced trader, you know that the underlying principle of success in trading is limiting downside and maximizing upside. And the strategies that you've learned so far certainly stick to that principle. With the overlay strategy, what we're doing is we're taking that concept, which of course is all about convexity, and we're applying it now at the account level. If you have a strategy that helps to reduce the overall account drawdown when your core strategies are losing, but doesn't stop you from making the same amount of money overall in terms of profitability, then I'm sure you would agree with me that that is a good thing. Limiting account level drawdown without limiting the upside on your trading is, of course, a very powerful principle. And that is what the overlay does. So when you trade the overlay strategy, remember, it is not designed principally to be profitable. The most important principle that we are trying to apply here is at an account level, we're looking to reduce the depth of those drawdowns without limiting the extent of our profitable periods, if you like. So when we see our equity curve going up, we want to be seeing those peaks reach a similar level, but the dips in our equity curve should be shallower. So we will look at some charts on that and a few diagrams as we go through the training to make that clearer, but that's just a brief introduction. All right, so you should be able to see all of that here in the introductory section. Now, remember, if you're going to be able to apply this strategy in a way that is going to be helpful, as with all trading strategies, it is absolutely essential that you are completely consistent in your trading. All right, so let's move on next to have a look at some charts and talk about the selection criteria. Now, I just want to point out that there is some flexibility on this depending on what strategies you are trading for your core strategies. If you are trading the impulse strategies only, and in this case, we would be referring to the H4 impulse, then it is only suitable really for you to trade the overlay when the selection conditions are appropriate for an H4 impulse. If you are also trading a hybrid strategy as a core strategy, then there's a little bit more for you to think about. And in fact, in the example that I'm going to be showing you here, we are going to be looking at a specific situation where a hybrid was taken. And in this case, this trader should also have taken an overlay. And we will see the benefit of that in a minute. But to keep things simple, what I'd like you to remember is that to trade an overlay strategy, we are effectively looking for the same conditions as we would trade for an impulse strategy. So in the case of the H4 impulse, we would typically be looking obviously for trending conditions and to be in an impulse wave of that trend on the higher selection time frame. Now, the examples I said that I'm showing you here is a hybrid strategy, and it's a little bit different from that point of view, but it doesn't really change anything, because as long as you're able to say that the conditions were appropriate for your hybrid strategy, then potentially they could also be appropriate for you to look to trade the overlay. What I'd like you to do for the moment, though, is for us just to pretend that these conditions are appropriate for an H4 impulse. So what I'm basically saying is that let's consider this to be a valid M pattern. And for this to have been a valid M pattern, then we would need it to be a class 1 M pattern. Unfortunately, it's not for this particular example, but I want to use it for a couple of reasons. But had this been a valid class 1 M pattern, then we would have certainly been looking to trade the H4 impulse in a bearish direction if you are a WM trader. Now, it has to be said that if you are specifically a channel trader, then these conditions would not apply, because you would need to be outside of the channel. And that's something that's really important that I'd like you to remember, is that if you're not really looking to trade your core strategies on a particular instrument, then you're also not really going to be interested in trading the overlay strategy either. One final point on that, though, is if you wanted to practice trading the overlay, if you wanted to trade a broader variation of the overlay, and that therefore would not be a gamma overlay, it would effectively just be a counter trend strategy, then you would be looking at any impulse or phase 1 wave, regardless of whether it's in a trend or in a range. So that is a possibility. We will be looking at different ways of counter trend trading in the future. So rather wait for that, I would suggest, and look to trade the overlay in the stricter sense, which is the gamma overlay, at least for now. All right, so that should cover the higher time frame selection criteria. Just to summarize, it's easy to remember that the criteria should be the same as for your core strategy, be that the H4 impulse, or in this case, as we're going to see, an H4 hybrid. Right, so let's look at the 4-hour time frame. And here you can see that bearish cyclicity on the 4-hour time frame, basically representing the wave on the higher time frame. And you can see how the bearish cyclicity actually has broken down here. You can see it with these dotted lines where we had the last bearish phase 1, followed by a phase 2. Remember, that is a phase 2 because it failed to close higher than that high. And then another phase 2. Now, why do I say this bearish wave was over? Well, we then had a bullish engulfing impulse candle. And for me, as you know, that is a sign that the preceding wave is potentially over. Now, it might not have been. It might have rolled over and carried on going, making that a non-relevant high, isolated high. That's fine. I always look at engulfing candles, especially if they are also an impulse candle, as the potential end of the preceding wave. So this bullish impulse engulfing candle telling me that this bearish wave was effectively over. Now, therefore, we'd have phase 2 breakdown in that bearish cyclicity. And the final selection criteria, the same as for our impulse strategies, we would need to have a bullish impulse candle, which we did. It wasn't much. If you look at the close over here, it wasn't much higher than the previous high. but the close there was 79.539, and the high here was 79.535. So 0.4 pips higher, doesn't matter. It was higher. And that is the final selection criteria for our H4 gamma overlay. Once you have that final selection criteria met, which would be an impulse candle in the direction of the trade, you can effectively enter at market. Yes, it also is possible to place a limit order, and that's often advisable if you are trading in low liquidity periods, which is normally around rollover. So in other words, around the start of the first 4-hour candle of the day. But generally, a market execution would be fine to enter at market at the open of the new candle, as soon as you've got that impulse candle. One thing I just wanted to point out in this regard as well, looking at our other criteria, is that we also like to have a valid pullback. So remember, if you haven't had a valid pullback, and which means that if your preceding candle is an impulse candle in the direction of the trade, then it wouldn't be valid. In other words, when this candle closes, we can't go again. It's the first impulse candle that we look for and no other. So do we have a valid pullback? You guys should have covered the training on the anatomy of a pullback in the technical analysis section. But here, this candle over here is in itself a valid pullback on its own. Simply having a lower high and a lower low is enough for us to be able to say that we've had that valid pullback. So ready to rock and roll there. Enter at the open of the new candle. What about the stop? Well, the stop should be ideally below the preceding fractal. And of course, if you've got an impulse candle, then, I beg your pardon, not an impulse candle, an engulfing candle, then we will treat the low, in this case, of that candle as a fractal, despite the fact that the next candle hasn't yet closed. So that is obviously slightly pushing the definition of a fractal, because normally it needs to be set in stone, but we would treat it as a fractal in any case. Now, that isn't always the case. This impulse candle here didn't necessarily need to be an engulfing candle, in which case, had this been a higher low, that would have been the fractal there. So that's the ideal spot. But as always with our trading, we don't want to have trades where our reward to risk ratio is compromised. So that is still trying to stay on the side of at least limiting downside, maximizing upside, the convexity. Now, even though we're not trying to implement convexity at the same level as we do for our core strategies here on the overlay strategy, it is something that we're not going to ignore completely. So should the distance from your entry to the fractal stop be more than the ATR of this time frame, and that is different, obviously, from the core strategy. So for the H4 impulse, you'd be using the selection time frame. We use the ATR for the overlay of the execution time frame. And as you can see here, at the time where we entered the trade, the 21 ATR was 32.4 pips. You should, in fact, use a 30 or 34 period ATR on the 4-hour time frame. So just bear that in mind. That's the best time to obviously use that. And you'll see that that trade has actually just been stopped out now, and I'm going to come back to that in a second. But the maximum distance from entry to stop should be the ATR of the execution time frame. In this case, it is the H4 time frame. All right, so what about the take profit? Well, the take profit likewise is that same number. The take profit for your overlay is the H4 ATR, and in particular with a setting of 30 or 34. And that is exactly what this blue bar is showing over here. So let me just illustrate that. And if we wanted to just double check that, it's 32.4 pips is what we would have been looking for, which is just under that number there. And as you can see, this trade would have actually hit its take profit already. In this case, the stop for the fractal stop was well under the maximum that we're prepared to look at. So we were happy to use this as our stop. Remember, we have a small offset there, only of 1% of the ATR. So just add on that offset. Some people just add a pip to give it a little bit of grace below the preceding stop, and that's all fine. All right, so that would have been the entry, initial stop, and therefore the take profit up here being the execution time frame ATR. Here's another example of a bullish gamma overlay. Now, what I'm going to do here is not only show you the management of the trade, which is really what this video is all about, but I'm just going to also summarize the selection criteria for you. As always, repetition is a good thing. So here we had a valid class 1 M pattern, which for those who are WM pattern traders, you'd have been looking to trade an H4 impulse in a bearish direction. That means that we had reason to believe that we were in a trend using those that selection process, and also a phase 1 of that trend. Certainly it was a confirmed phase 1 at the close of that day. So those are the two higher time frame selection criteria met for a bullish overlay. So in order to look for the final selection criteria, we need to drop down to the execution time frame being H4. And here you can see that bearish cyclicity that represented that bearish wave, which came to an end twice, in fact. So let's have a look at both of those. You'll notice that here we had a bullish overlay. Why is that? Well, because we had this bearish impulse wave followed by a very short phase 2, bullish phase 2, and then a bearish phase 2. And it, given this bullish engulfing candle, giving us reason to believe that bearish wave at the time was over. So there you can see that we had a breakdown in the bearish cyclicity with a phase 2 followed by an expected phase 2, and the final selection criteria being a bullish impulse candle. We were able to enter a trade here at the open of the next candle. The initial stop, as you can see, we couldn't use the fractal low because the ATR on this was 26.2 pips, which was obviously, as you can see here, a little bit less than the distance to the ideal fractal stop. The take profit was equidistant on that. Now, that was the timing, entry, stop, and take profit. The purpose of this video, of course, is now to tell you about how do we manage the trade. And this is where things really get quite interesting with the H4 overlay. I would also like to point out in this first trading video is that there are a few variations on this. We've tested quite a few of them, and the one that I'm going to show you now is the one that we are currently using. So do look out for changes on this in the future as we develop our ability to trade the strategy more and more effectively. Okay, so once this trade had triggered, we kicked into the trade. You'll notice that unlike some of the others, in that first 4-hour candle, it didn't get to the take profit. So what we do with the H4 overlay is we give it 2 4-hour candles, give it a chance for a total of 8 hours, 2 candles after execution to hit the take profit without moving the stop at all or adjusting the take profit. You'll notice that in the second 4-hour candle, it got pretty close to hitting the take profit, but likewise, it didn't manage to get there. Right, so then what do we do in that case? How do we now start managing the trade? Well, let's look at the stop first. The first thing we would look to do is to trail the stop using an aggressive trailing stop. In other words, we would trail the stop to behind the last closed candle. Now, had that been there, which it's not in this case, we would have trailed the stop to below that low, almost completely eliminating the risk. In this case, however, the last closed candle was this one, and as you'll note, the low of that candle was in fact above the entry, meaning that if we trailed the stop there, it would be trailing it beyond break even. And as you know, with the aggressive trailing stop technique, we only trail to break even. So in principle, we would have trailed the stop to the break-even point. However, now we move on to the take profit. How do we adjust the take profit for the H4 overlay? Well, what we would do is adjust the take profit to an equivalent distance from the entry that we've moved the stop. And of course, if we've moved the stop now to a break-even level, in principle, we'd look to move the take profit to that level as well, which of course is ridiculous because the price was already at that level, which means that, as I'm sure you've guessed by now, what we would do is we would close off the trade at that level and simply take that profit. And it's pretty much as simple as that. In some other examples, we will probably see where that's not so much the case. In which case, if you're still trailing the stop, all you do is you reduce the take profit proportionally. So in other words, if we had halved our stop on this trade, I'm just surmising now that if we trailed the stop to this point, then our take profit would have been adjusted to a similar level. And in this case, it would probably have gone up and just hit that take profit there as well. So again, we'll look at some more examples of this going forward. And obviously, I'll also include it in the notes below. Now, this pair has given us 2 overlays in a row. So I'm going to use this as an example to illustrate that. Why do I say that? Well, first of all, you'll notice that that bearish movement resumed. In other words, the higher time frame, phase 1, carried on going a little bit further. So even though we'd already had an overlay trade here, regardless of the outcome, this was a confirmed bearish phase 1 in terms of the H4 time frame, showing us a resumption of that bearish cyclicity. That cyclicity again broke down. Now, our higher time frame criteria are still met because we still have reason to believe that we're in a bearish trend on daily and reason to believe that we are in a phase 1 of that trend. So that is what this bearish cyclicity represents. We then see a breakdown of that cyclicity. So the phase 2 here, as expected, nothing wrong with that, but followed by another phase 2. And here we have an instance where we didn't have an engulfing candle immediately. What we did have was a second candle after the low was in fact formed, giving us our bullish impulse candle. So breakdown and sequentiality of cyclicity, valid pullback. That candle alone is a valid pullback, as you know. And that then followed by a bullish impulse candle, giving us our final selection criteria being met on the execution time frame, which then leads us into timing. What do we do on the timing? Well, the entry would be at the open immediately of the next candle. Our initial stop, this is actually incorrect. Our initial stop could be below the fractal low, but what we could also do is maintain that stop below that candle's low. Now, in the past, I've shown you how we can use if we've got an engulfing candle, that would be a fractal low, and that otherwise you could look to use the fractal low if that's not the case, and this would be an example of that. But one of the things that we also do, and I do typically, is I put the stop below the low of that last closed candle. It's almost like the aggressive trailing stop technique would require us to do, and obviously less a little bit of an offset. So there we have it. That would have been the entry, the initial stop, and then the take profit would be the ATR at the time the trade was triggered, which in this case was with a 21 ATR would have been 25.94. But obviously you want to be using a 30 or 34 ATR on the H4 time frame. Now, unfortunately, this is not going to show me help me to show you how to manage the trade, because it went straight to the take profit on this one. So that was a nice little winner for us there as well, compensating for that smaller winner over there. But I will look for other examples to show you how to manage the trade. Let's go and have a look for a bearish one. So here on the higher selection time frame, you can see that we were in a bullish trend and a bullish phase 1 of that trend, particularly if you are a channel trader. Not so much, of course, if you are a WM pattern trader, as that was not a class 1 W pattern. However, bullish impulse wave outside of the channel, and therefore we had both of the selection criteria met, not only for the overlay, but of course also for an H4 impulse, and that's very often the case. So here we would be applying the overlay against the H4 impulse strategy. So those are the higher time frame selection criteria met. So it's dropped down to the execution time frame being H4. And here you can see that bullish cyclicity, which came to an end with a bearish phase 2 and another very short phase 2 from that isolated low to that isolated high. followed by a bearish impulse candle. Here we have another example of a trade where not only do we have the impulse candle, but it's also an engulfing candle. Did we have a valid pullback? The answer is yes. If you add up our points over here with an engulfing and an inside bar, you'll know that we had a valid pullback. And of course, this isolated high being treated as a fractal as well, because this is an engulfing candle. So valid pullback conditions met. The breakdown in cyclicity, of course, on this time frame being met, and a bearish impulse candle. So those are the selection criteria for a short trade on, in this case, the dollar Swiss for an H4 gamma overlay. Let's look at the timing for this particular trade that we had here on the dollar Swiss. So being a bearish H4 overlay, we waited for that bearish impulse candle, and therefore our entry was on the open of the next candle. The preferred stop level, of course, is the fractal high. In this case, remember, we add not only a small offset, but also the spread. So that would have been our preferred stop level. But in this case, as you can see, that distance was further than the ATR on this particular pair. Now, remember, for H4, we'd be looking at the 34 ATR, but here, even if we look at the 21, you'll see that it is in fact 21 pips, and this bar over here represents a 21 pip stop, which would have been at that level. Likewise, our take profit on the H4 overlay is also the ATR, the 34 ATR on the H4 time frame, and you can see that that is equidistant. So that would have been the entry, the initial stop, and the take profit for this strategy. In this example of a bearish overlay, I'm going to have to take you back a little bit in time to a period when we had an initial breakout on the HTC channel. So this would have been a channel trade for those folks looking to trade the H4 impulse and looking for the end of that impulse wave. So that's the breakout wave, as you can see here on the right-hand side of the chart, where we previously had a little bit of consolidation in this market. We did also have a hybrid trade, as you can see here, but as soon as we got that breakout and we had the confirmation that this was a potential trend, which was the end of that day, we would, of course, then recognize that these selection criteria were appropriate for an H4 impulse. Reason to believe that we are in a trend and a phase one of that trend. So that certainly, as you know, would have been reason to believe that we could place trades or look for our execution criteria for an H4 impulse. But at the same time, it also means that we can start looking for a bearish overlay. So let's drop down to our execution time frame, which is the 4 hour. And here you can see we had that strong bullish cyclicity on the H4 time frame. We had our first pullback on this time frame around this point over here, followed by that bullish impulse candle being a perfect setup for our H4 impulse. So that would have been a trade that you would have executed right there. But what about the overlay? Well, let's keep looking. Now you'll notice that immediately within the next few candles, we got an isolated high, ringed isolated high, without the next wave being a phase one wave. And this is quite a crucial thing to note. Had we got a higher close here, this would not have been the appropriate conditions for a bearish overlay, because we would not have seen a breakdown in that bullish cyclicity. However, as soon as we did get a ringed high here without having had that higher close, and as you can see, that is very much the case here, we were able to say that that bullish cyclicity had in fact broken down. The next thing we'd need to look for is obviously would be a bearish impulse candle, which is exactly what we had here. There's the bearish impulse candle. Happy to short the market at the open of the next candle. Now here again, we have an example where the ideal fractal stop was too far away. So we needed to use an ATR stop, simply being the ATR for this time frame, for this pair, which was 49 pips. And our take profit was equidistant to that. So that would have been where we would have open our new trade with an initial stop and initial take profit right there. So moving now onto the point of this video, which is management. How we have managed it? Well, we would have waited for 2 candles to complete themselves before we did anything else. So in fact, that was the first candle. It didn't go on to take profit. And then we had a second candle, which did even less, not going towards our take profit at all. At that point in time, what do we need to do? Well, then we implement our aggressive trailing stop rule, which means we would need to trail our stop to above the high, in this case, of the last closed candle, plus our offset and spread, because that's a bullish, a buy order. And then likewise, look to move our take profit an equidistant amount of pips below our entry, which of course would have been above the current market price, which means that we closed off the trade, just taking that profit there as is. And that's how we would have managed that trade. What is noteworthy about this is the conjunction of our bearish overlay with the bullish impulse trade that didn't work out. So in this case, you'll notice that looking at our H4 impulse, using the 3-6 rule, we would have been stopped out over here, which means we wouldn't have been able to reduce our risk on this trade a lot. And likewise also on our bearish overlay, it's obviously a pity when we notice that afterwards it does in fact go on to take profit, and maybe with some other rules, we've tested a few as well, we would have hit our full take profit there, but overall this seems to be working best for us in any case. The point being though is that you would have made back some of the loss that you had experienced here with the H4 impulse. So combining these two, the total loss would have been about half, in fact, of what you would have lost had you only taken the H4 impulse without having that overlay. So worth pointing that out, and that comes back to the purpose of the strategy, which is not so much about being profitable, but reducing the drawdowns caused by our core strategies. So that really brings to an end this training on the H4 overlay. I hope you guys have found it useful. So you can see here that we are in a bearish trade, an H4 impulse, in fact, using the fact that we've got a valid class 1M pattern here on the daily time frame, and we're obviously in a bearish phase 1 of that. It was a potential phase 1 at the time. In any case, you can see very clearly over here, if we drop down to the H4 time frame, that we have got bearish cyclicity intact. So whilst we are in an H4 impulse that seems to be doing reasonably well right now, we are also watching this time frame and this pair for a breakdown in that bearish cyclicity, so that if we do get that, we will look to take a bullish overlay. Right, hope that helps. Do drop any questions that you might have for this into the comments box below, and I'll answer them all individually. Like the video, and if you haven't subscribed to our YouTube channel, make sure you do that. Even though this is members only training, it's important that you stay abreast of the latest training as it comes out. I do provide free training there as well, and you do want to make sure that you get that. Super, guys. I hope you've enjoyed that, and I'll chat to you all soon. Bye for now.